Hey folks, it's Doug Tabor, CCIM, multifamily broker and host of the Rental Market Update. And this is your rental market update for Los Angeles County MSA for February 2025. And I wanted to pick Los Angeles because, they're coming out of a rough first quarter. The wildfires were just absolutely devastating for Los Angeles. I've talked about it a little bit on the radio show, but, the fact that they lost over 10 or 12,000 structures, I don't know what the final number was, but it was a lot. High profile loss and devastation, lots of multi-million-dollar properties. And then also Altadena area where they lost a lot of properties. There are basically three wildfires that they were having to deal with. And it's just horrible, horrible devastation to an area that's already been struggling with a lot of issues. There's just a tremendous housing shortage throughout all of Southern California. And this didn't help. And there were a lot of apartment units and rental properties that were lost during this wildfire season there, which is really just not going to help the rental market. Now, maybe if you're a landlord that didn't experience loss, you now could probably raise rents. But now there's, big concerns that there's going to be landlords that are going to be gouging. And so the Department of Real Estate has gotten involved. And, there's just a big heavy legislative spotlight shined on that area. So it's just not a good situation. But anyways, I just thought I would take a moment to do a rental market update just so you have an idea of what the numbers look like for that market. So let's dig into the numbers. As you know, I always like to start with the jobs because I think that jobs are the most important aspect of any rental market. And the unemployment rate in Los Angeles County is not extremely high. You're currently at 5.7%. By the way, on our rental market updates, we do a 12-month look back. So this is a trailing 12 on our updates. We're not forecasting anything. We're not predicting any future trends. This is really just a 12-month look. The 12-month job growth, total non-farm, is 1%. So not a lot of jobs getting created. I will say that Los Angeles County, being a part of Southern California, has an incredibly diverse job sector. They have a lot of different manufacturing. They have a lot of different, obviously the movie industry is there. There's a lot of finance industry there. It's a hub. Los Angeles is clearly one of the top markets in the world. So job diversity there is very strong. However, there is population decline there, showing a year-over-year population decline in Los Angeles County of negative 1%. So they are not experiencing an increase in population. They are experiencing a decline in population. I think last time I checked, they had like 10 or 12 million people. I'm from that area, and I just would not want to be packed in there with another 10 million people. That's a lot. County vacancy is at 4.8%. So these are all pretty good numbers. You got a 5% unemployment rate. You've got sub 5% vacancy, which is certainly good. That's a good number that a bank likes to see, around a 5% vacancy rate. Annual rent growth, pretty flat, which is true about most of Southern California right now. Annual rent growth in Los Angeles MSA is 1%. The current average market asking rent depends on where you look. I use CoStar for a lot of my data. There's also Zillow. And between those two, you're looking at about $2,300 to $2,700 a month for an average for rents. And that's usually based on a two-bedroom apartment. A lot of people ask me that, is that for a two-bedroom or for a one-bedroom? It's an average. So you put them all together, and that's your average. So $2,700 a month on the high end of your average. That's about the same as San Diego. So I bet if we went into Orange County, we'd probably see about the same. Rent compared to the national average, well, it's Southern California. The rents are about 34% higher than the national average. So certainly you can go outside of Southern California and get much better rents. I wanted to take a moment to talk to you about our webinar that covers exit strategies for owners of appreciated rental real estate. You see, when we sit down with folks, generally they've owned these properties for 5, 10, 15, 20, even 30 years. And what they tell us is that they're just tired. They're tired of the telephone calls. They're tired of the toddlers, the termites, the taxes, on and on and on it goes. The terrible tease. You've heard it before. And so they want to know what their options are. There's a lot of information out there on the internet, and a lot of it's, quite frankly, untrustworthy. So that's why Aubrey Morrow, certified financial planner, Bill Exeter of Exeter 1031 Exchange, and I created a 60-minute, easy-to-watch webinar that covers your exit strategies if you own highly appreciated rental real estate. We basically follow a case study of a couple of apartment owners who approached me one time and said, hey, we want to sell our apartment building. We'd like to know what our options are. And so we follow that process. Now, their property, when I put a valuation on it, which, by the way, that's what we recommend. We recommend that you get a valuation first by someone like me, someone who can give you a broker opinion of value or CMA. Then we recommend that folks go and meet with their CPA. What we've discovered is that folks want to know what their options are, be it if they want to keep the property in the family, which in some states that may not make sense. With Prop 19 in California, it's harder to keep a property these days. You may want to just cash out and pay the taxes. And we go through that exercise. Now, for these particular owners, that was going to be $1 million tax bill, which is pretty significant. So they chose not to do that. And then you have the 1031 exchange options. And that's where we bring on Bill Exeter, who through his company over the years has done over 135,000 1031 exchanges. I mean, Bill literally wrote the book, and writes the book, updates it every year, a guide to 1031 exchanges. And we will make a copy of that available through this webinar. But Bill covers all the different aspects that people have questions about regarding the 1031 exchange. And then Aubrey Morrow and I come back in and talk about your options. Now, really, you can go two different directions. You can go into something more active. Maybe you want to sell your single family and roll up to a fourplex, or you want to go from a fourplex to a larger apartment building or some other commercial property, maybe in some other state. That's always an option. But what we found is 80% of the folks we sit down with are looking for something more passive to invest their equity into. And there are many options out there. You can go into a net lease property. You can buy a nice fast food restaurant in some other state somewhere and make a good return and not have to do anything. Or you can go into something like a DST or Delaware Statutory Trust. There's also charitable remainder trusts. So there's lots of different options, which means there's lots of different questions. So if you have some of the questions and you're looking for some of the fundamental options, register. It's easy to register. Just go to rentalownerworkshop.com. rentalownerworkshop.com. It's an hour-long pre-recorded webinar. You can watch it from the comfort of your home. If you have any questions through the program, you can actually submit your questions, and then we'll follow up with you. After you register, we'll follow up with you with a telephone call or an email just to see if we might be able to give you some additional information. We don't share your information with anybody. We just like to be able to reach out to you and see how we might be able to help. So rentalownerworkshop.com. Hope to see you there. Take care. Los Angeles CPI. We like to look at CPI because when we talk about the legislative issues, which we're going to get to in a moment, CPI is always important because AB 1482, which is the California statewide rent control bill, basically says that you can raise rents as a landlord 5% plus CPI. And so the local CPI of a market is very important to know because that's going to be your rent cap plus that 5%. So basically you're looking at max rental increases because of AB 142, which is a statewide bill, of 8.3% in Los Angeles. So right now, max rent increases of 8.3%. And today's 30-year fixed mortgage rate based at the time of this recording, February 2025, they've actually come down 6.79%. We've seen the 10-year drop a bit, and it's caused the interest rates to come down a bit. So that's good. They've been hovering right around 7%. They've even gone over 7%. So dropping down to 6.79% is a good thing. We want to see that lower because we need to get these markets moving, and that is not happening as long as interest rates are where they are historically. I mean, quite frankly, a 7% interest rate's about normal. Problem is we're coming out of a very abnormal time over the last 5 years where we've had artificially low interest rates and we've gotten used to the 3% and 4% interest rates. All right, let's talk about the single-family detached numbers. In the last 90 days, there's been 1,079 home sales. The median sales price is $875,000 in Los Angeles City. And what I really like to look at most is the median days on market, currently 53. So that's pretty long considering a Southern California market. For a single family property to sit on the market for 53 days, that's kind of getting towards the buyer's market time frame. So that was an interesting statistic. Now let's jump into the 2 to 4 unit properties, the small rental properties. The median price per unit, which is what I really like to track on these properties because it allows you to kind of compare. So if you own a duplex, a triplex, or fourplex in LA County, this would be your median price per unit, $375,000 per unit. So that's a pretty good number, $375,000 per unit. If we look at the 2024 numbers a year ago, we were at $381,000 per unit. So there has been some decline in the price per units. Prices have come down a little bit, but we haven't seen an incredible decline. Median gross rent multiplier. I like to track on the 2 to 4 unit properties the gross rent multiplier because when you think about the smaller independent owners, the people that buy a duplex, a triplex, or a fourplex, they aren't really focused on the expenses. If you know the difference between gross rent multiplier and capitalization rate, the gross rent multiplier just measures the income, whereas the capitalization rate measures the income and the expenses to get a sense for how well your property is doing. So on the smaller stuff, we usually go GRM because expenses vary wildly. But a gross rent multiplier of 13.98 means that it's kind of getting to a buyer's market. If you can find a 13 or 14 times gross property, that's a pretty good number for an investor. That would make an investor look at something more desirable. Some of the beach cities, for instance, are closer to 25 and 30 times gross. So when you think of a 13 or 14 times gross, that's looking pretty good. Now, if you look at the difference between last year's GRM, which was almost 16, and now we're almost down to 14, now we've dropped 2 points on the GRM. We can see that again, prices are starting to come down on these rental properties. And then the days on market for the 2 to 4 unit properties is 99 days on market. Generally, they say once you get past kind of 70, 80 days on market, you're now moving into a buyer's market. As you know, we've been in a heavy seller's market for the last 5 years, ever since COVID. We were looking at 7, 10, 12, 15 days on market. And as a reminder, days on market is from the time a real estate agent puts the sign in the ground to the time that property goes under contract, not closes escrow. It just goes under contract. In other words, an offer was accepted from a buyer and they're moving to the escrow. That is our days on market. And that's how we, as realtors especially, we track demand in a marketplace. So for a property to sit 99 days on average, and I use medians, what that means is I'm not combining them and doing an average. I'm trying to find the middle of what those averages are. And 99 days on market, that's a long time for a property to sit before it goes under contract. So what I see here in these numbers is that your days on market are pretty high for the 2 to 4 units in Los Angeles. Let's jump over to the larger apartment buildings, the 5+ unit apartment buildings. And we are looking at a median price per unit of $246,625. That's a bit lower than the $271,875 of 12 months ago. It's not a lot lower. I mean, you're talking small percentages there, but it is going in the direction of lowering. That means, again, prices are starting to cool. We think that's just a reflection of interest rates for sure. Capitalization rates. Now here with the bigger stuff, the 5 or more unit apartment buildings, I do use capitalization rates because that's a really common measure. We've gone from 4.38% average capitalization rate to 5.38% capitalization rate today. So that's a full 1% cap rate increase, and that's pretty significant. To go from a 4.5 cap to a 5.5 cap, I think you're going to get investors that were previously sitting on the fence to jump into that marketplace. I know a lot of investors to buy in at an actual 5.5 cap in Southern California, which is just such a strong rental market, would probably come into that market because they know that they can come in and they can probably improve that capitalization rate by raising some rents or lowering some expenses. So then you start getting into 6% cap rates, and now you've got a market that's paying off some good dividends. But again, median days on market, we've actually seen a huge increase in the last 12 months in the Los Angeles MSA. They've gone from 84 days on market 12 months ago to 125 days on market today. So certainly that market, the more than 5-unit apartment building market, is starting to see a lot of price reductions. Remember, the higher the cap rate, the lower the price of the building. So if you want a lower price building, you're going to get a higher price capitalization rate. Let's talk about some of the issues I see with Los Angeles. Anybody who's watched my show, I've sold apartment buildings in San Diego County, and I'm not a big fan of investing in Southern California for a number of reasons. Mainly it's because of the government overreach. And let's talk about some of the issues that Los Angeles is facing. You know, we talked a little bit about AB 1482, and that's been around a while. One of the big ones that LA came up with, which just blew everybody's mind, is this Measure ULA, the mansion tax. And basically what it says is that anytime you sell a property over $5 million, you're going to pay a 4% tax on top of that. So you sell a property over $5 million, 4% tax. If you sell a property over $10 million, you're going to pay a 5.5% tax. That's just crazy. Basically what that's saying is that they're just going to tax the snot out of you if you sell your apartment building. And really, it's probably causing people to not sell, which is why you're seeing limited inventory and limited transactions. So the mansion tax is just nuts. Everybody thought that when they imposed that tax, and I'm just surprised that people vote for this. But there's a lot of tenants in LA County, and there's also a lot of people that are middle or lower income, and they just want to stick it to the old man and get that tax. Of course, you have throughout the state of California Proposition 19, which some are calling that a death tax. The problem with Proposition 19 is that, let's say you pass away and your plan was to leave your apartment building or your rental property or even your home to the kids. Well, Prop 19 came out and essentially said that if the people who inherit that property, your beneficiaries, don't move into it, then they're going to have to pay the new assessed value tax rate. In other words, the protections that they've had over the years through, Prop 13 and having the lower tax rate, that property is going to be reassessed at current value, and they're going to have to pay those taxes. Boom, that's going to blow them out of the water, especially a lot of these properties where, mom and dad just didn't raise the rent, especially on the apartments or, the rental properties. And I've seen it a bunch of times where mom and dad doesn't raise the rent. Little Miss Jones has been there forever, and she's been paying $50 a month, and that's okay. They loved Mrs. Jones, but when the kids inherit that property and they now inherit a huge property tax bill because it's reassessed, we all know it's Southern California. It can go up 10x in just 10 years. Now you have a problem. You're upside down potentially on your cash flow because of the fact that Prop 19 raised your tax bill. Couple that with a huge issue that we have in California, and that's the insurance rates. These wildfires are not going to cause that issue to get better anytime soon. And so now you have higher tax rates, you have higher insurance rates trying to get those properties reinsured, and you have just a lot of problems in California, especially in Los Angeles, California. So that's my rental market update for Los Angeles, California. I hoped it helped. If you're looking for a printed version of this, go over to my website at dougtabor.com. Look under the resources tab. I will have copies of all the rental market updates as I go through them. That's all I have for today, and I look forward to seeing you next time. By the way, don't forget, like and subscribe. Thanks a lot.